Hey, welcome back to Harvesting Income channel. This is Sri. Today I'm going to introduce the fund which some of you might have heard before. This is a fund which is providing you the exposure to the US market, which is meant for Canadian based investors who like to get exposure to US stocks, especially the blue chip or the stocks which are part of the S&P 500 index. So the questions that people typically ask is, does this provide me a good amount of income? Does this have a good amount of appreciation potential, and how does it work, etc. This video is going to answer all those questions, and let's get started. Hey, welcome back. As a Canadian, you are looking for a fund which can invest in the US market and give you that exposure, that kind of returns, plus also the income along with that. So SMAX, which is the US Equity Yield Maximizer ETF. This is from the Hamilton ETFs, and Hamilton ETFs is known for all these income and growth oriented funds. And this fund was started October 2023, about close to 3 years now, and they have assets of about $1 billion, pretty large in terms of the size. And the portfolio is like mostly large cap and large companies similar to the S&P 500. And the goal here of the fund is to provide you that steady high income plus long-term appreciation or growth potential. So that's the fund from Hamilton. It's called the Hamilton US Equity Yield Maximizer ETF, and the ticker symbol is SMAX. So before we go ahead, this video is purely for educational purposes, not financial advice. I'm not a financial advisor or licensed advisor here. So do your own due diligence and consult with a professional. Okay, with that, let's look at the structure or investing strategy followed by SMAX. Basically, this fund holds the stocks directly, so there is no fund of fund or multiple layers here. Like the fund directly holds the stocks, the US stocks, and the investing strategy involves writing at the money calls on stocks so that they can generate the steady income. At the money means the call options are written at the current market level, which will give optimal option premium or optimal income from the options. Secondly, they provide the long-term growth exposure and dividend income from the blue chip companies. So it's a kind of balance between growth and the options. So 50% it's covered by the call option writing, and the other 50% has full upside. So that's how the fund is designed. I will show you the portfolio quickly to give you an idea of how um, this works. So let me have this set up for you. Uh, I'm quickly going to the SMAX portfolio page here to show you the holdings. So this basically contains all the blue chip companies that which are part of the index. Okay, here we have it. So if you look at the list of companies, like you might have heard of these names already, like it's very popular names: Micron Technology, AMD, Cisco, Broadcom, Amazon, Alphabet, Apple, Eli Lilly, Nvidia, Caterpillar, all the big blue chip names that you have been hearing about in the media or in the news. So these are mostly the companies which are part of the S&P 500, not strictly following the index, but it's a mix of companies which are part of the index. And Hamilton basically writes covered calls which are at the money to generate income, plus to provide you the appreciation. Okay, I will keep this open for any other reference materials. So as we move ahead, we'll learn about other aspects. Like one is the expense ratio. If you look at the expense ratio, it's 0.65. And management expense ratio totally comes to 0.78. Management fee is 0.65, just to clarify that. So fees are kind of reasonable because the fund writes call options not on the entire index. They write call options on the individual stocks. So which means that you have the higher potential of earning more income because stocks are more volatile than the index. So obviously the option premiums are going to be more richer. So there's a potential to get higher level of income. Of course, there is a higher level of risk as well, but you're going to get that higher income. So that's the reason you see a slightly higher fee compared to the plain old uh, index ETFs. And in terms of the returns, this fund generates a price return of 6.7%, whereas the distribution is pretty higher, 8.1%. I know this sounds little low, 8.1% is pretty low, but if you see the total returns, it's in 14.7%. And given the fact that it's all blue chip companies, you have a strong growth potential and you have a steady distribution. Over a period of time, if you are buying today, like your yield on cost is going to, you know, gradually increase over a period of time as you hold that ETF for a longer period. That's how I look at it. But if you have interest in more higher yielding ETFs, like you can look at other options as well. So this is also an option that you can look at. But the good thing I see that it's the price returns are also positive. Like you are not uh, having this problem of NAV declines. Sometimes NAV erosion also can be a major issue. So yes, there could be a possibility when the markets are down, you might see price declines. But in this fund, it is fairly minimal as of now. Like since we are in a bull market, but time will tell you whether what will happen at that time. But distributions are pretty decent, consistent. So 14.7% yield, it's a pretty decent one. And what kind of strategy they use? Basically, they write covered calls on 50% of the portfolio. So that's the 50% they maintain, and they write calls at the money. So that gives steady flow of income to the fund. And the remaining part of the fund is 50% is uncapped, which means there is no covered calls. So which means that remaining 50%, two things can happen. One is the remaining 50% has full exposure to the upside, number one. Number two, since the 50% is uncapped and they hold those stocks and that 50% is not sold out, the stocks, underlying stocks are generating dividends too. So that dividends are also going to come into the fund. Eh, Dividend yields may not be that great, but still you have that stock dividends also coming into the fund that is going to give you that cushion, especially in flat or bear markets. That cushion is going to help you. So this is a kind of a balance between income and growth. They're trying to strike a balance in terms of trade-off between income and growth potential. Okay, any fund cannot be perfect. Like some funds are very good at generating a lot of income, but they lose in terms of the growth potential. So this fund has a lot of pros. Let's look at the pro side and then we'll look at the drawbacks. One thing is that since this fund holds blue chip stocks and it's a diversified portfolio, you can hold it as a core position if that suits your requirement. And you have moderate and sustainable yield. This fund doesn't give you like 20% yield or anything like that. It's currently 8%. Probably it may go to 10% range, but it's not going to give you like massive amount of yield. But the good news is that Hamilton is very good at maintaining the distribution to the extent of income earned by the fund. They don't overpay. So over a period of time, you will see that gradually the distributions increase once the fund manager is comfortable that they can pay out so much. So they are very good at managing that payout schedule over the period of time. So yield is sustainable and no leverage is used in this fund. So that's also a reason why the yield is slightly lower because no leverage has been used. And you have a direct stock ownership, like a very easier structure compared to owning another fund, and that fund owns the stocks. So it's a little complex in other funds, like some of the funds like HHIS. It holds other covered call ETFs, and that covered call ETF owns the stock. But in this case, it's a direct stock ownership. It's a simple structure, and you have the higher income potential plus higher upside, like I already explained. Last 2 points are very self-explanatory. Coming to the other side, like the part of the portfolio where the covered calls are written, you have a cap on the upside. So let's say the strike price is little higher, like 2% above the market price. So your returns are capped at that 2% above the market price for that month. because the calls are already written off, and your upside or returns are capped at that level. If the market rallies like 10%, like you don't get that full upside. You get only that 2% because your returns are capped. So the other second point people always criticize about this is this may not beat the index ETF. Okay, one thing that I want to say here, this second point is not a bug or not an issue. It is actually a feature of covered call ETFs. Covered call ETFs are not designed to beat the index. They are designed to capture a significant portion of returns of the index. So in one of my previous videos, I talked about return capture ratio. Like you can look at that to get an idea. Uh, how much of return can the covered call ETF capture? So I would say that covered call fund should capture at least 60% of the returns of the index, because covered calls will have a slight lag in the returns. They have to capture at least 60%. It's my personal opinion. Like you can have your own ratio, and these yields are not going to be super high, but you have a slow starting yield like 8%, and you bought at a certain price. Once the distributions gradually start increasing, that 8% yield can go to 8.59 over a period of time. Of course, it's not guaranteed. The distributions are very variable, and it's also subject to market conditions and various other factors. So those are the pros and cons of this fund. You have a good mix of uh, you know uh, yield and appreciation in this fund, which is very good for this fund, and that it is very good for long-term investors who don't want to check the prices every time, and they want to set it and forget it and keep it for a longer run. This is a good fund to look at. Okay, this is the case study, a story of someone who invested in SMAX 1 year ago. So I've taken a case study from a person who has invested 1 year back. The June 27, 2025 is when they invested $100,000. So investment they put in was 100,000, and doing the math, the units accumulated was 3845. Let me zoom it a little bit so you can see it clearly. 3845 is the amount of um, units they accumulated, and on the left you can see left down bottom portion, you can see the annual distribution income they got was $8,057 for the whole year. This is for the year, annual distribution of 8057, and they made it works out to like 671 per month. That's the return that they made, because the fund gave them some return 6% per for the whole year. And if you look at the total returns here, um, on the right side, top corner, you can see investment of 100,000 and appreciation of 6689 and distribution income for 8057. So adding all that, the whole 100,000 became 114,747. So just to make the math very simple, on the $100,000 they earned 14,747 extra. So which means that they made like 14.74%, which is the total return we discussed in the earlier slide. Uh, Appreciation was like 6,689 and distribution was 8057. The good news here is, like, see, $8,000 in a year is not a small sum of money. Like, it's still a decent chunk of cash. As of now, they are making like 671. Like you can see on the area that I marked on the left side, 671 is the dollar amount they are making monthly as of now. And it has, as of the previous 12 months, but it has grown to 768. So in the last 12 months, on an average, they made $671. But as of now, the dividends have gradually grown. At the current level, they are making about $768 every single month. Again, not investment advice. You can double check the figures and go with some amount of caution. You know, uh, but the data shows that as of today, like 20 cents is the dividend, and $768 roughly is the monthly payout that you're getting on the investment of $100,000 made 1 year ago. So that's a great amount of income for for this kind of investment. So, and that is going to grow. Like, see, already it has grown by close to $100, like 671 to 768. It's almost like $97 roughly. Like, so you have already grown it by $97 in that 1 year. Next 1 year it can grow up a little bit more or probably same level, but still you are still growing by a smaller amount every year, and that is dramatic. Like if you keep growing at this rate, probably in couple of years or 3 years, you will reach 1,000 per month on a same investment of $100,000, and you are not reinvested back any dividends back into the fund, and you are not made any extra investments on the side. The same $100,000 is growing, and it's going to probably touch $800 a month, or maybe $1,000 a month in 3 years. That's the kind of power of compounding that you can witness if you invest for the long term. So that's the message I wanted to show. This is the real case study that I have just taken some pieces of information and presented to you. So you can look at your own scenario and see how these returns will pan up. Like if you put in 100K or 10K, and see how it works out in the future in terms of distributions, in terms of capital appreciation. So so the message is clear. This is a great fund if you're looking for a mix of growth and income. Now, some people ask, like, what are the other options I have? Like, this fund is just giving me very low yield. So the other alternative picks that I have mentioned here, there's one thing you need to remember. This fund is focusing on the US equities or US stocks. But there are funds which I have mentioned here that not only covers US stocks, but they cover an entire basket of assets. So these are like all-in-one funds which I am recommending. These are not recommendation. Basically, these are the alternative options that I am suggesting for you to look at. Again, do your own research, and you can look at one of these, or you can even look at other funds that you may have researched yourself. So HYLD, this is one of my favorites, suitable for someone who is looking at US stocks, but you have various other different sectors covered calls ETF packaged into one. Like you have the technology, healthcare, energy, oil and gas, everything packaged into one solution. So which is HYLD. It is from the same fund house, which is Hamilton. The name of the fund is Hamilton Enhanced US Covered Call ETF. The second option you can go for is like HHIS, if this suits you. This is Harvest Diversified High Income Shares. So this fund holds about 20 other funds, 20 other funds, like fund of funds. Basically, they have their own other sectoral funds, like healthcare one, the oil one, etc., etc. Like similar to the HYLD, they have different sectors. But the good news is they cover most of the blue chip US stocks. They might be covering a few of the Canadian and other kind of stocks as well. Uh, but here the company is investing in the individual covered call ETFs, which are all blue chip stocks. Small correction, these are all US blue chip stocks. HDIF is the last one. This is where you get a mix of US and Canadian stocks. So you have an all-in-one solution. Like you have one fund which holds different sectors stocks, and you have different sectoral ETF packaged into that HDIF as one solution. And you can look at this one as well. Like this is another option, but you note that this may exclude some sectors. Like they may not have like mining companies or gold or silver companies, for example. So these are what I like. This is not a ranking or rating or anything like that. So you can do a research on this, or if you have any other ideas, or you have invested in other funds which are similar to this or better than this, please drop them in the comments below. I like to hear from you. So with that we are coming to the end of this you know end of this presentation. I hope you like this video, and if you want to share any comments or feedback, please drop them in the comment section below. And if you like this video, please give it a thumbs up and please subscribe to the channel. Thanks a lot. Have a great day.